Welcome to the Risk Reversal Podcast. I'm Dan Nathan. That is Brian Belski. He is the Chief Investment Strategist at BMO Capital Markets.
Well said.
Welcome back to the pod,
Thank
Brian.
you so much for having us.
We got us, you, and the rest of the Canadians.
Oh yeah, the whole rest of my team.
Yes.
That drives people crazy when I say us. I've been so ingrained. Maybe it's the Minnesota guy in me.
Yeah.
But I'm been so ingrained. It's not about me. It's about I have an amazing team that's worked for me. So thanks for having us.
Yeah, no, I like that when you talk about like kind of the work that you've done, right?
Yeah.
You preside over a lot of work. You're the
Yep.
big thinker, and then your team kind of drills down on a lot of the stuff.
Yep.
So it is your team. Lot to talk about.
No.
You were last on March 28th. At the time, you had a 6,700 price target in the S&P 500. I think the S&P was probably trading around 6,000 then. Here we are at about 6,200, and you still have a 6,700 price target. We're gonna just kind of figure out what happened between there and then. And then I want to talk about like what you're thinking some of the big drivers are. The last week, there's been a lot going on. Obviously, the tax bill. We're really kind of drilling down on trade. By the time people are listening to this, it's going to be Wednesday morning, and it's going to be the date in which the administration's set for lots of trade deals.
Yep.
All the good deals. I want to get your take. Geopolitics, is that in the rearview mirror? Does that matter a whole heck of a lot? And then anywhere else you want. I want to drill down on some sectors and how you're thinking about the back half of the year. I just want to start here. This was in your note from last week. Back to the Future, restoring our initial $6,700 and $275 in earnings targets for the S&P 500. All right. Market targets are about optics and academics. Investment discipline matters most. Strategists live by the sword and die by the sword. It is the nature of the gig. We are championed when our published price and earnings targets nail our projections and mocked, ridiculed, and shamed when we are wrong. Okay. The last part, has that happened to you anytime soon? I don't think so. You have been a staunch bull as long as you've been coming on the pod for the last 2.5 years.
No, thank you. I'm glad that how we started this talking about us because I have an amazing team, and one of my fantastic team members has worked with me for 18 years. And he's got one of the greatest names in Wall Street history, Nick Roccanova, good Irishman, right? Yeah. And I picked him off the fixed income desk at Merrill. And I really believe that you should hire people that think differently than you because you need to be challenged. And he's challenged me, and he's really helped me provide the guts of our U.S. strategy work since Merrill. And we were talking about the market. I mean, obviously we're talking about the markets, and Nick came to me, and we're kind of like brothers now. And he came to me and he said, I think they need an Uncle Brian piece. And what I mean by Uncle Brian piece is when we do like a one-pager where it's me just going off. And I could have taken a victory lap. I could have, you know what I mean? But that's not how I roll. And we wanted to make clear that we really believe in this whole mantra of stocks lead earnings versus lead the economy. It's about the stock market. And I think too much is made of strategists' price targets because it truly is an academic practice. And nothing drives me more crazy than we come up with a PE ratio and an earnings. It's not that easy. Okay, it's not that easy. We have these complex, deep models for earnings, our PE regression models on the market, and then our market targets on the market. I mean, there's a lot of fucking work to do. It's not just as easy as doing that. But for all intents and purposes, I think I wrote in their piece too. If you're buying the market, brother, or deciding what portfolio to make, I can swear, right?
Yeah.
Based on my fucking market target?
You already did, by the way.
Yeah. Wait a minute. Belski's moving back to 67. I'm buying?
Yeah.
What the fuck?
Yeah.
No. And what we did in April, I'm sure we'll talk about it like a week after I was here, we went down to 6,100 and we made this line in the piece, similar Uncle Brian report. Discretion is the better part of valor. But we made it very, very clear in that report, Dan. We own what we own. We're not changing a thing, and we didn't. And so I'm very humbled to say that I had the very best performance on a net and absolute basis that I've ever had in my investing career of running real live money for 25 years now in the second quarter.
Yeah. And that's important. You just said running real live money, because those portfolios that you construct exactly do that. And you kind of, in your Uncle Brian piece, you said, for our part, we have always defaulted to our process and discipline of how stocks, industries, and sectors define markets and portfolios. Okay. So like portfolios are different than markets, right? So you just said net and absolute and this. So describe that a little bit, how, again, you feel very proud about how you did in Q2. You didn't change anything. The academic process of targets, we can throw that out the window. What can you kind of relay to our listener that will help them think about that in the next? There will be another period like we just had.
Absolutely.
Now, that was violent, the sell-off, right? It seemed like an own goal, if you will, but we came back. As violent as the sell-off was, the fervency of the rally back was that to the same extent.
So part of our longer-term investment process, when from a fundamental perspective, is we take a look at valuation, earnings, operating performance, and then price performance. But we also overlay, when we're looking at individual stocks and how they fit into industries and sectors, with respect to what is the actual company do? What's their addressable market? What's the product or service? What's their management? What is their track record in terms of management? All like in really true fundamental stock picking. And then we take a look at how it fits into particular indices. We run 10 different portfolios for our great system at BMO, and we have 10 different benchmarks. So we have to know what the benchmark is. This is true kind of portfolio fashion. And we typically run 50 stock portfolios for all intents and purposes, because we want to go big or go home. I mean, we're not going to own everything. And so, for instance, what we decided based on all the fundamental factors that I just said, plus our process is this. This is how we decided that over the next 12 or 18 months, we want to maintain our overweight positions in technology, communication services, consumer discretionary, and financials. That all of that added up in terms of what we're seeing in sectors, especially in the United States, to still back up our 25-year secular bull market theme. If you believe that, and if you believe everything that I said in terms of the wherewithal of those factors, and didn't listen to the fear, and didn't react to all of the whatever you want to say about the president or what's happening, most of what happened was due to your personal opinions about the president of the United States. It was, period. And about fears about tariffs and all. We didn't know. We still don't know, by the way.
Yeah.
And I think what's happened is everyone's kind of stepped back and said, whoa, we overreacted again to this. And all of those intrinsic fundamental things have not changed. And in fact, some of them, I could say, have strengthened. So we decided to maintain our underweight in the Mag 7, but overweight tech. We decided to be more stock picking in consumer discretionary, more stock picking in communication services, especially in small mid cap. And then in financials, our themes. Our theme of scale, really big and really small banks. That's what we really like. And we ultimately think, again, what's coming out of this is deregulation. We're going to have some consolidation that's going to be good for earnings. And we think, too, on a very short-term basis, why I think financials, and make us feel really good, Dan, about that 275 number on the market for 2025, is that I think financial earnings are going to rip. They're going to rip.
All right. And we're going to get a good test of that, or at least
next week.
So we start off, I think JP, Citi, Bank of America, a couple of the investment banks. I just want to go back to one thing.
Yeah.
And you're not wrong about one of the reasons why, we had such a sharp sell-off, I think, is that a lot of folks, it didn't have to do with how you felt about the president. It had to do with the rollout of this new policy, which had the potential to be massively destabilizing, not just for our economy, but the global economy. And you are also correct that we don't know how this is going to shake out, because maybe a lot of this volatility that we've seen just in Q2 or towards the end of Q1 into Q2, maybe that's a bit of a precursor. Maybe this secular bull that you're talking about has the potential for a year like 2022, that sort of thing. And so who knows? You don't know. I don't know. Your 275 number, it might be really low. It might
Could be
kind of high if we have, let's say, a blended rate, tariffs of the back half of the year of 20%. If we have, growth kind of slow because we're at peak margins, that starts to hurt margins. And then maybe you come up with a 240 number, and then if you're 6,200 still, markets can be expensive because your number 275
at
on
240, the number is really expensive. 620. I have $240 at 6,200. That's an expensive market.
Well, a lot of your competitors ratcheted their numbers down for S&P earnings, right down to those levels or whatever. But before we kind of move on to some of that stuff, because I think that's important.
Yeah.
Are we ever going to have a protracted bear market again?
Yeah, we will. We will. So the other thing I want to talk to you about and what happened in April, I really believe, Danny, that this is a microcosm in behavior that really was exacerbated by COVID, but really began, I think, during the tech wreck. I mean, we can get philosophical, but
going back 25 years.
I do. I really believe that. So, but and we can unpack that if you want. I'm using a therapy term. I've had therapists. I've had a lot of therapy in my life. Anyway, so I really believe that we in society make so many binary decisions, man. We make left, right, Republican, Democrat. Which way am I thinking, right? Buy, sell, stocks, bonds, or stocks, cash. All Europe. I'm going to all Europe, right? Or all Canada. I have a lot of my Canadian clients, Canadian brokers, God bless you. They've been very supportive of my stuff. I'm not buying any American stocks anymore, and I'm not coming to the United States for a vacation. Like very binary, emotion-led decisions, okay? And I always caution people, never make any decisions based on emotion. And I think people got riled up and it was very, very binary. To answer your question in terms of a recession, yeah, we're going to have a recession. We're going to have a recession when people stop talking about the recession. And I believe it's going to be a normal recession because after all...
All right, let's define that. And actually my question was a protracted bear market. Do we have a protracted bear market because it sniffs out a recession? Because that's what 2022, the market was attempting to do.
It was attempting to do.
It just never happened.
It never happened, I think, because of the way things reversed from the fixed income side, if you remember, in October, November of 2022. And then 2023 was all about the oversold recovery of tech stocks. People completely forget that. And are we dating? What are we doing? So what do you do when you're not really committed, or dating a little bit? You dip your toe in the water, and you dip your toe in the water in the United States stock market with liquidity. Same thing happened in 1995 following the 94 kind of mini recession. We had a bear market, commercial banking crisis. Everybody went into big large liquidity companies that were consumer staples. In fact, those names define the Nifty 50, and those names also define Alan Greenspan's very famous speech of rational exuberance. Most people think it's about technology. It's about consumer staple stocks. It was before you were right.
No, but it was late 95. I think it was December 95, wasn't it? Or 96, one of the two.
Yeah, it was late 96, but you had a hell of a run.
Well, 25% years in the S&P 500 for 95, 96,
it was
97,
it was amazing.
99.
So going back to that, I mean, I think ultimately we're in the path to normalization. I really believe.
All right, so define that, because are we talking about, growth pre-pandemic? The GDP growth was 2.2% the 10-year prior. We've had, Fed funds, 4.5% is probably high over the last 20 years. A lot high is probably double the average, right? Inflation, we were worried pre-pandemic about deflation. Now we're trying to get inflation down to a 2% target. Is that what you mean by normalization?
Yeah, I think double-digit earnings growth, double-digit performance for the market. I'm going like old school returns for the stock market, old school returns, like 50-year returns for the market. PEs of, let's call it 15 to 20 or 15 to 18. I think we can get there with, especially if earnings start cranking up. Remember, you have a numerator and denominator. If the numerator it's just math. I don't know. It's my life. If you look at if price does not spike and earnings actually start to outpace price, that could actually happen. I do. And then lastly, I'm not a fixed income person. I, for one, stay in my lane. What drives me crazy, get equity people talking fixed income, and they have no idea. I think a 350 to 450 range in the 10-year treasury makes sense. And in that circumspect, you can have the dollar kind of hovering where it is right now. Again, I'm not a currency person either. But if you go back in history and everyone's looking to see the dollar can go actually a lot lower, I'm I'm not quite convinced, but again, I'm not a currency person.
Run-of-the-mill recession. How long does it take, in your opinion? The markets will sniff it out before we have confirmation of that. 2022, the S&P 500 traded down, 27%, closed down 22%. 2023 gets started. We have a couple regional banks go under. There's some liquidity provided. Obviously, we're going to look back and say, well, ChatGPT, when it was launched in late 22, that started something that a lot of folks did not think was going to be the driver the way it was, not just from a CapEx and economic standpoint, but think about the trillions of dollars in market cap that have accrued over, let's call it 15 names that have been a huge driver of S&P 500 earnings and S&P 500 performance.
Right. So let's go back to the banking crisis. I'm glad you look, banking crisis. 3 stocks. Okay. So talk about another period where everybody made a binary decision. We're having a financial crisis, banking crisis. I mean, we have 4,000 banks in the United States of America, 600 publicly traded banks. I mean, come on. There was nothing systemic about it. It was about 3 bad apples, and that ATM was for private equity. It wasn't for Mr. and Mrs. Wilson in Walnut Creek.
You say that, but where is a lot of that capital in the VC landscape that has funded a lot of those companies? It comes from pension funds. You know what I mean? So like there is a scenario where, and I've been kind of bringing this up to some of my VC friends, definitely on the pods, it's like there are pockets of risk out there.
Oh yeah, there's
that
always
are not particularly transparent. Look at what happened or has happened in private credit. If you're not getting your antennas up, and I don't mean you, about, all the products that are trying to be created to go to retail investors that, are based on a lot of this private credit investment. I mean, like they're out there, man. Like, and at some point we're going to look back and be like, some of the warnings were there.
I think you're sniffing down the right path there. And I think that could have something to do with the next bear market and or recession. I think we'll have some sort of a normal recession, whether or not it's a consumer recession or CapEx recession, I'm not sure. Remember, in 2008, we had all 3, the credit recession, consumer recession, CapEx all together. Boom. And that hardly ever happens. And so I think people that haven't lived through a normal recession with just one of the C's happening, they're automatically going to go back and look for 2008 again. Well, we got over our skis. Ultimately, I think this big, giant secular bull market, Dan, will end in a financial crisis, because it always does. And we'll have a major blow up. But I really believe, and I'm not just saying this because I'm stubborn Belski, Pollyanna Belski, no analysis, which I've been accused of doing, no analysis, and always being positive. I think that there will be a big blow up at the end of this. But I think we're at least 10 years away.
All right. So tonight on Fast Money, and by the time people are listening to this, you will already have watched, because I think everybody watches that show.
Everybody does.
5 p.m. Eastern, Monday through Friday. Steve Eisman, and here's a guy that I've gotten to know, and Danny well, and Vinny and Porter, and all 3 of those guys worked for Steve during the financial crisis. Steve has been steadfast. He comes on our show. We do talks together in front of audiences. He doesn't care about debts or deficits or anything. He said, someday it will matter, but not now. Yep. Are you in that camp? And are we just whistling past the graveyard if we're just want to push that, kick that can down the road and not deal with it now? Because this is one of the reasons about this tax bill that frustrate a lot of Republicans and obviously a lot of Democrats and probably a lot of folks in between, because it just does not acknowledge these problems that both sides feel sooner or later we're going to have to make some hard choices on.
I do believe that's coming down the line, and it could also be part of that. So if you take a look at the deficit, you take a look at private credit, you take a look at the impacts of private equity, I think that kind of trifecta could be part of the really big unwind in 10 years, maybe not the next recession.
Will you just do one thing? Will you define what you believe to be a secular bull market? Because you're going back to the end of the bear market, which was really 2002, right? We had 2000, 2001, 2002. I think a lot of people forget that 2002 kind of felt worse than 2001.
It did.
Sooner or later, it's just there's no optimism left.
Well, I saw someone on the CNBC today talking about 2002 and how the dollar was so weak. And it's almost like people don't have any perspective about what the hell was going on in the world in 2002. Remember, we had 9/11, We had 2 recessions in the United States. We were coming out of the CapEx recession in California, and that drove the stock market lower and all of that. And then 2002, if you think about that, between 2000 and 2002, you had this massive bottom and recovery in oil and commodities and the euro and anything to invest in anything but the U.S., right? 2002 was bad. I mean, I remember July of 2002 in particular. I was at Morgan Stanley's offices doing a lunch meeting, and the fire alarm goes off. And this is when they were in the McGraw-Hill building, okay? And the CIO looks at me and she says, "I'll never not listen to a fire alarm again. Let's go outside." So we held the meeting right outside there by Del Frisco's. So we're doing the meeting outside. And I'm getting these calls that, the world's blowing out. Like technology was like down huge. John Chambers came on TV and said, "I really actually don't know what our growth rate is." John Chambers.
Yeah.
Remember,
Cisco CEO.
He was the man in the 90s.
Yep.
Sick flow, and everybody loved him. Anyway, I bought the Qs that day. I still own them. But that was 2002 was a really, really ugly year. So I think that from a secular bull market theory, we came out when I was still doing U.S. strategy and sector strategy at Merrill for my year ahead forecast for 2009. I wrote it in November, December 2008. I said, we're bullish for 2009. It wasn't a very well received report, especially at Merrill at the time, because we were involved in a hostile takeover from Bank of America. Just to put that out there.
I was there then, by the way.
I know. So I put this report out, and oh man, I got a lot of crap for it. And it wasn't ultimately why I was pushed out in January. It was just that Bank of America decided they had too many strategists. And I get it. So then I caught on to a place called Oppenheimer, and we changed the call saying that a bull market has started. And then a year later, 2010, we redefined the call and said a secular bull market started at least 20 to 25 years. This is a bull market similar to the 40s, 60s, 80s. And this one is really driven clearly by sentiment, but valuation too. It was cheap. If you remember too, there were all these market targets for Mariel Rubini had a 500 market target on. And when the market hit 666, that, if you know your biblical notions, that's the mark of the beast. And I was actually excessively bullish during that time frame.
In 2007, November, there's a level of irony here. John Chambers also gave some very poor guidance, and it lacked visibility, and that was the top of the tech market then. I mean, people forget that, what happened in 2008, it was fits and starts, man. Bear Stearns went under the first week of March, and it looked like that was just like cleaned up, and JP Morgan got another sweet deal, and move on. So that it is interesting. Now, one other thing though about that period when you made that call in 2009, valuations were very depressed. Sentiment was very poor. Right now, you're looking at this Mag 7. The valuations are pretty healthy right now.
They are.
And they've already achieved, if they probably pulled forward a lot of performance, I have to think, for 2026.
I think so. And remember too that these companies people are buying them because of liquidity. We're underweight because we don't own Meta, and we own some smaller positions than a couple of the other ones. And that's why we've been more overweight names like Oracle and Palantir and AMD and Broadcom, because we believe those are the ones that you want to be in relative to the others in terms of from a positional standpoint. But I do believe there's going to be other areas in the market that will pick up some of the performance slack. And so you talked earlier about financials and what could happen there in terms of the sector. One of the things that we look at, again, going back to the very beginning, we look at valuation, earnings, operating performance, and the price performance measures. In the earnings side of things, we run these exhaustive earnings revision models where we look at current fiscal year versus next fiscal year, and we look at all 500 companies of the S&P 500 from a bottoms-up basis, and then build these models. Their diffusion indexes already lost people. It's just math. Anyway, you look at trends, right? If earnings are way up, I get tactically worried because analysts are all raising their numbers at the same time. What we've had, seriously, this year so far is you've had a massive amount of negative revisions, and revisions are bottoming and they're starting to turn, especially in areas like financials. So I think that numbers actually are too low, and they're set up like they haven't been for several years in terms of under promise and over deliver.
All right, but how do you square then a JP Morgan, which is obviously clearly a market leader? It's approaching that $1 trillion market cap. That'll be the first time we've ever seen. It'll get there.
Yep, of course it will.
Like, trading at 2.2, 2.3 times book, that's nearly like 3x Citi. It's nearly double Bank America. And Jamie Dimon often says, I don't buy, our stock when it's over 2, that sort of thing. The stock is up 45% off of the April lows versus an S&P that's up 30% off those levels. It's like there probably isn't that much more as far as like upward earnings revision. This is a low single digit, revenue, probably mid to low, earnings, that sort of thing. Maybe that yield curve is helping out a lot with NIMs. We're waiting for capital market activity to really kick in. But again, to me, and I don't do the work that you do, okay? I don't have the team that you, when I say me, I mean me. I don't have us, you know what I mean?
Yeah.
I have Bill. That's what I got. I got Bill.
You get a Bill and a thumbs down.
I got Bill.
So I would say that JP Morgan's a gold standard. All hail Jamie. He's a great CEO. Part of why JP Morgan's done so well is because of liquidity and its biggest bank stock. So people feel good and they feel relatively safe. Remember a couple of years ago, everybody hated Citigroup. Bank of America's kind of in between there. So I think from the big banks, you can, from a portfolio management perspective, you key on some of the things that you said in terms of capital markets. Now, Goldman had its issues, but I think Goldman's back. Think about this. When we were working at Merrill, right? Did you ever think that you'd ever hear Goldman Sachs talk about private wealth like they do now? Come on, man.
Well, GSAM was a huge, that was like, and GSAM was also really important to the franchise, right?
Yes.
Because they serviced a lot of these CEOs.
But look what they've done in the RIA space and all, you know what I'm saying? So, but Goldman's got that sweet spot, I think, for the second half of the year, because if valuations continue to go higher and we still feel pretty good about the market, we're going to see some banking deals finally. But I think where the capital markets business is going to do very well in second quarter earnings, because we make money during volatility. Trading volume is going to be off the charts for second quarter, and I don't think people are talking about that enough. And oh, by the way, the great wealth management shops did a really great job. And so I think wealth management and global markets with inside capital markets are going to be the key things that investors should be looking at least on a short-term basis. I think longer term, okay, let's go back to JP Morgan. So what do you do with these banks? I think it's really hard not to have exposure to JP Morgan, but it's equally hard to be overweight JP Morgan. You follow me?
Yeah.
So you can't be too underweight. I'm just talking logistics, especially if you're running a 50 stock portfolio like we do. It doesn't matter if we're running value money, dividend growth money, tactical money, and we do it all. I think the next play, aside from my theme of really, really small banks with great operators, great management, great track record, great loan book, clean balance sheet, all that stuff, right? They've done really well. I think it's going to be the middle areas of these banks that can't compete with the really small banks, because the small banks are living and dying based on relationships, okay? Or the big banks that we mentioned already that have amazing balance sheets and are able to provide loans and all of that. I think we're going to see consolidation in that middle area because they can't compete with the big. It's easier to get bigger than it is to get smaller.
I like what you just said there. You can't be underweight them and you can't be overweight them. And, that's something that I think the way you run your process, the way you run your models, you can do that across 50 stocks, like you just said. A lot of folks who listen to this podcast or watch CNBC, either the shows that you're on or that I'm on, they're not thinking about the markets that way. They're thinking about what's the next opportunity, whether it's going to be some mid-cap bank, right, that has the ability to kind of take out a competitor or merge with a, they're always looking for ideas, as you know. And you do a great job of that when you come on these sorts of, it's not how you actually can run money every day. You are doing fundamental research on names, on industries, on trends, that sort of stuff. So it's interesting to me, though, because, JP Morgan, went down 30%. Now it's up 30%. We can do that math. You know what I mean? Now it's broken out to new all-time highs. And we keep getting the question, well, don't I want to buy best of breed here? This is a hard time for the market. And, Guy and I say this all the time, and we've been looking at these markets or trying to articulate them to retail investors.
Yep.
You speak to retail investors,
yep,
but you also manage these portfolios. And, one of the questions they always have is like, where do I find value? How do I own something that, you know what I mean, is underappreciated? And it's hard to find. I mean, that's the trick, right?
Yeah. So, our institutional accounts, we do talk to all the time, and more from a point where are they afraid of? And a lot of people were so late to getting onto the Citigroups and because they wanted to be in JP Morgan. But in terms of looking for value, I really think that 10 years from now, we're going to be kicking ourselves, Dan, that we didn't own more value stocks and more small mid-cap stocks. And from a value perspective, just looking at what we like to call just intrinsic value, book values below the market, PEs less than the market, having positive earnings so they're not a value trap, something that we talked a lot about at Merrill, and then debt to equity below 1. But you also have to look at value from a contrarian standpoint. Where can you be contrarian? What company tripped on itself that's actually a really good company, but maybe they got a bad CEO and that CEO is going to get fired, you think, but they've got a good product and they can turn it around? So that's why, like recently, some of my recent picks in the value portfolio that I put in there for a certain amount of time because they gave a value opportunity. In 2015 or 16, I believe, Costco had 2 bad quarters in a row. Like they really screwed the pooch. Stock was down 120% put in the value portfolio. Sometimes they give that opportunity. I did the same thing to Netflix in 2023. Recently, I bought Starbucks a year and a half ago when I saw the CEO on TV, the previous CEO talking about $9 mango teas. That's not real, right? So I had a feeling that the dude was not operating that company very well. So stock was going down. And then they hired Brian from Chipotle, and now the stock's been pretty decent. Recently, I put in Nike because Nike's just got crushed. Nike rallied, sold it, and I put Lulu in. Lulu's not a value stock. At 15 times earnings, it is relative to where it has been, but you're looking for an opportunistic that got crushed operating-wise, good operating company, good product. They just kind of got ahead of their skis on some things. And so that's more of a value trade, but that's where you can find some value in the market.
All right, you're a Minnesota guy. Does Target fit that description?
Oh my gosh, yes, it does. So we own it in our value portfolio. We own it in our dividend growth portfolio. I think, to me, Costco's top 25 company in the world, just period. That's really the model. And Walmart's done such an amazing job. Target's way behind. And they had their own problems a couple of years ago. I think the CEO, Brian's got a lot of work to do there. The stock is cheap relative to the other two. So relative to those two, it clearly provides you with more value.
All right, what about Google?
Google added my value portfolio too. I'm just, listen, maybe I'm getting old, but I just don't think that we're not going to use search anymore. Like I talked to my team members I got one I call him a Zier, and like, hey Z, are we gonna use?
That is contrarian, by the way, because I think the market's come around. I mean, I think one of the things that's holding the stock back is definitely regulatory. I mean, these remedies. But again, we could have called that bugaboo for the last 10 years on a bunch of these names, but this might be the one. So, and this will be really interesting under this administration where the promise was deregulation. I don't really believe that as it relates to mega cap tech. I think that Trump has always had it out for these guys going back to 2016, and we'll see how this plays out. Apple is trying to kind of wiggle themselves out of some regulatory stuff. But to your point about search, we'll see. You know what I mean? It could happen a little by little and then all at once, but we'll see.
But from a management perspective, it is a very well-managed company. They're bringing back some of their OG people to help them with projects. I'd like to see stuff like that. And then here's just like one piece of fun trivia I like to talk about. I love the company Netflix. I love it. I mean, it's a fantastic company. It's the Kleenex of streaming. Do you know if you do some of the parts on Google and you take out YouTube, it's bigger than Netflix?
Yeah.
Think about that.
I do know that.
That's amazing.
Yeah. Well, and again, I mean, there's a lot of folks who've argued that if you do like break this company up, the sum of the parts will be worth, a lot more than $2 trillion. But then let me ask you this. You just said you were underweight Meta. That might be the cheapest name of this whole Mag 7.
I don't own any of it. Zero. We made that bet. And for a long time, it was a great trade because from a correlation standpoint, in terms of how Google and Meta traded together, it was perfect. So for price correlation. Then, Google had its issues and Meta took off. You don't have to own everything. Where I've made up in terms of tracking error and clearly performance is Spotify. I've owned Spotify since 2017 and been really lucky on that. I first put it in my mid-cap portfolio and then I graduated. Like when your kids grow up, they graduated into, but I think in Netflix obviously is a big holding in communication services. I look at sectors and what I want to own in the sector. So that's how I kind of think about that. But
all right, let's talk about some sectors. And again, it sounds like you like mid caps here, maybe some small caps too.
SMID, I run a SMID cap product and I looked at, honestly, I saw my second, I know I said this in the beginning, my second quarter numbers, I'm doing this, when's it going to end? And then I get really nervous when things are going really well. But relative to the benchmark, our SMID product was the best performing. So we have a lot of great small mid-cap banks in there. We own a company called On Shoes. Yeah. We've owned that for 2 or 3 years. I really challenge my team for broader themes. And we don't get everything right, man. Like we bought American Eagle earlier in the year, or actually we bought it in May. We held it for a month. It was wrong. We missed it. So if I make a mistake, I'm out right away. And then we put the money elsewhere in consumer discretionary, but we bought Reddit. Now Reddit's not a Brian Belski type stock, especially because it was one of the meme stocks in 2021. But what Reddit does and provides, I think, from the business plan and the product, I think it can be there for a while. Okay. But we also own Shake Shack. And I was pushing my team. I said, why do we own Shake Shack? And the theme that we came up with is that Shake Shack is to Gen Zers what Chipotle was to millennials. I think that's the new one.
Yeah. Well, it's funny. It just made a new 52-week high. This is Shake Shack. I've been watching it off the bottom. And I've also been watching because, it was tracking Kava and Sweetgreen, which obviously are two very different things. Very different. I like the thing that you just mentioned, though, Gen Z versus the other. And, there seems to be a lot of dispersion, though, in this space in general. And McDonald's has gone sideways. That sort of thing. So, yes, do you consider this name discretionary? Is Shake Shack discretionary?
Yeah, it's technically a discretionary name.
So how do you feel about consumer discretionary? You mentioned that's discretionary. Nike just had this move. Disney just had this move. Starbucks has acted pretty well. I think those are pretty much a consumer discretionary bucket that you could kind of glean some stuff from.
I love them. I bought more, but I also bought more Marriott when it was down because everybody was convinced they're not going to travel anymore. Well, Marriott is an amazingly well-run company. Delta is technically an industrial company, but we bought more Delta when everything was going wrong. We actually kept our positions in Home Depot because at the end of the day, I know Lowe's, we own Lowe's in our value portfolio because it is cheaper, but at the end of the day, Home Depot is the OG there. And I think we don't know exactly when housing is coming back, but we do know that people are going to start fixing up their houses and put them on sale.
Okay. Do you think value is defensive here? Okay. Because we just talked about some of these growth names that are getting pretty expensive. We can all take out a few, but maybe Google, maybe these are ones that, are controversial, right? So in general, though, when you're looking at a Microsoft or an Apple, which is not really a growth name, but they're trading 33, 34 times earnings, right? Versus an S&P versus your numbers 22.5 times.
Yep.
It seems a bit rich, right?
Yep.
If we are starting to sniff out, let's say, slower growth and maybe a CapEx pull in a little bit, you know what I'm saying? Like, again, we had this kind of tailwind, I think, of these CapEx numbers skipping higher and higher over the last 2 years or so. At some point, you're going to go X growth and that sort of thing. And folks are going to be like, maybe that is a sign of lack of confidence in the, return on investments or use cases, that sort of thing. So is value, in your opinion, defensive?
Well, yeah, you think about the biggest parts, the value index are financials, right? So I think that would be a really great place. When you think about defense, on page 72 of your business book, you buy consumer staple stocks. That's why I hate it. I hate consumer staple stocks, except for Walmart and Costco, which aren't really staples, but the S&P.
But they're getting really expensive too, by
they're
the way.
super expensive.
They're trading like Microsoft
right.
valuation.
So, but look at like Kellogg's and Kimberly-Clark and Procter & Gamble and everybody rushed into those stocks in April, May, and that was exactly the wrong time to buy those names. But they're really expensive. And there's some utility names that are kind of expensive, but we kind of like some of the utilities. So I think if you take a look at it like a true fundamental value right now, just fundamental value, you're actually going to have some tech in there like IBM and Cisco, but you're going to have a lot of financials. You'll have some down and out consumer discretionary like Target, like I said, Lululemon. You're going to have some REITs in there, some utilities, but you're going to be pretty concentrated in financials because that's where I think probably the most value is in the market.
All right, let me just hit this because I definitely want to hit tax and trade here. When you think about NVIDIA, last year, it was 25% of the performance of the S&P 500's 25% return. So now the stock is not up 150% like it was last year, but it's up 18%. It's up 85% from its April lows. Now, valuation looks reasonable. This is a name that I think a lot of folks have just kind of been a little bit in awe, but they just kind of hold their nose and let it go, And I'm just curious what you think about going back to 2022. Netflix is a name you loved. NVIDIA, I'm not going to put words in your mouth, but again, I suspect you're probably underweight-ish here, if that's fair to say.
Yeah, so we had a template response to everybody emailing us
about NVIDIA
and Shopify in 2022. I mean, it was because we were getting crushed.
All right, so this is where I was going to go. NVIDIA, Meta, Tesla, Netflix, they were all down 70% from their all-time highs in 2021. And I just thought it was interesting in April when we used to get a lot of questions about these names and people could not believe that stocks got cut in half in 2 months.
We call that 2-for-1 split the hard way.
Exactly.
We're neutral to slightly underweight. And let's go back to the JP Morgan comment, right? Really hard to be overweight and really, really hard to be underweight, especially if you want to outperform. But I do believe in my great friend Dan Ives. He's the godfather, man. Jensen's the godfather. He sits on top of this.
I love Dan. Dan is a nut.
I'm having dinner with him tonight.
You're nutty. He's a nut.
He
comes on our pod a lot, by the way. And you got a mic whenever you want, but you're like all over the place.
I challenge you to not speak like Spicoli when you're with him. I mean, you get he and I together. It's like, dude.
He and I had a meeting last week. Just me, him, and a friend who's a CEO of a small cap tech company, but a really interesting company. And my friend did not. He's seen him on TV, but I don't think he knew what he was getting into. And he's a fun guy, and he's a smart guy.
He's a really smart guy.
He's passionate, like you, actually.
Well, thank you. He's really smart. But the way I think about NVIDIA, so you have NVIDIA on top, and then I do believe there can be a Pepsi to NVIDIA's Coke. I don't know if it's Broadcom. I don't know if it's AMD. I don't know what it is. And then in between, you have what I like to call the facilitators, which are the software companies, which is Microsoft, Amazon, Palantir, Oracle. And then down below, you can start playing themes. Now, everybody wants to talk about power generation and all this kind of stuff. I've kind of taken two steps back, Dan, and thought about this, just as this dumb kid from Minnesota. The number one alternative energy company in the world is? It's got two letters in the symbol.
KO.
Play along, man.
It fuels a lot of people. I'm just saying.
BP.
Okay.
They spend more money on alternative energy than
I've seen the commercials.
Than the entire publicly traded market cap space of alternative
Wow.
energy. Okay, so how do we apply that to utilities? I'm thinking about this, man. Again, just Pollock from Minnesota. The OG companies have all the wires, man.
Yeah.
They got all the infrastructure. They got all the connectors. So I think the big winners are going to be the Dukes, the Nexteras, the Southern companies, even Edison out west. I mean, there's going to be some big high flyers that connect to the AI stuff, but I think the OG stuff. But I think Dan and I, we talk about this, Ivesy, but we talk about, I think that cybersecurity is a major AI theme. Major. So that's why we've been fortunate to own Palo Alto for a long time. It's tripped there a little bit, but I'm a longer term investor, and we own CyberArk as a small cap name. And Checkpoint. Obviously, CrowdStrike's the sexy one.
Checkpoint is one I haven't heard that name in a long time.
Yeah.
So listen, hopefully this is something you guys are taking notes here.
You're giving names, man, trying to add value.
No, no you most definitely are. Palantir is a name that I hope I'm right about it. I hope it's not like the next $1 trillion, stock, because then I've been wrong about it, for, $800 billion in market cap. But this is a stock that is trading at 90 times sales right now. It's got $4 billion in expected sales this year, expected to grow 25% next year. This is not, there are stocks, Anduril, which is a pure play in defense tech in the private markets, is growing faster. The revenue base is going to overtake that of Palantir, and it's got a $30 billion value. That was the last, valuation. It's going to be $100 billion, give it 6 or 9 months, that sort of thing. So I think there's interestingly, value in the private markets and a lot of froth in the public markets. That's not something you hear too often.
No, but I also think that's why I think that there's an amazing opportunity in small mid cap. And here's why: liquidity, right? I think there's going to be, let's go back to what's going to drive some sort of a recession or bear market. I think there's going to be some sort of liquidity event in private equity. And I don't know, but I think people are going to seek out liquidity. And who gives you liquidity? Small mid cap.
Yeah. All right. Let's hit tax. They did an extension of the tax cuts. There's a whole host of other stuff in there. I think that a lot of these legislators are going to be trying to figure that out when they go back into their districts and have to speak to their constituents about what exactly is in the bill. Because a lot of folks who actually benefited from the tax cuts, this is going back to 17, are not going to feel any different. You know what I mean? Like, it's just an extension of them. Now, corporates, there's a lot of little goodies in there, you know what I mean, for a lot of companies. Is this tax bill a tailwind for the economy?
I think so, just like it was before, just from an optics perspective. But I do believe that this will be, just from a feel-good marketing type thing, that will make people feel a little bit better. I mean, for all intents and purposes, we're still kind of climbing the wall of worry. There's still, even though stock markets are hitting new highs, people don't really, it's like people don't believe it. And they're still like...
Institutions?
Institutions especially. Private wealth has done an amazing job to be invested in this. Amazing. So I think institutions are still waiting. The emperor has no clothes. I mean, what's going on here?
Yeah.
Waiting for the next shoe to drop. And now they've missed this big move. That's why I think ultimately we could have some sort of a blow off top relatively soon. But I do believe that that'll drive, I think something will drive some sort of a normalized recession. Again, late 26 into 27. I think there's one coming. I just don't. It's not going to be this year.
Yeah. All right. So there's nothing in the tax bill.
No, there's nothing in the tax bill.
No. And I don't disagree on that. I think if the tax bill didn't pass, I don't think it was going to be, a big headwind either. By the way,
I think that there's a really good. So let's go back. So the tax cuts in 2017, right, and then 2018, the tariff noise, and then
by the way, and the stock market in Q4 sold off 20%.
Yeah, you know why? Because Trumpy was fighting with Powell, and they're giving each other the finger, and then he raised rates one more time. The market got crushed, and all
Powell
the bears
lost. He had to pivot,
and then entered in what? Goldilocks, right? And I contend actually that if the vid did not happen in 2020, I think we would have had a recession in 2020.
Oh yeah, the market was like the economy was already slowing in 2019 because it had that like sugar high. All right, let's talk about trade. These tariffs. Today, as you're listening to this, it's July 9th. We were supposed to have dozens and dozens and dozens of bilateral trade deals by now. You could tell by the president's Truth Social account, like all the threats that they're making and this and that, whatever. It's not going to happen. Secretary Bessent and Lutnick, they said, listen, it's probably going to be August 1st. And, all the deals are coming in. If we get to August 1st and we don't have any big deals, your folks up in Canada, they don't seem to be budging. They took that digital tax off. The Mexicans don't seem seem to be moving. The EU keeps kind of jawboning a little bit. The Japanese, the South Koreans, like there's not a lot of progress. At least we might have a lot of frameworks, but my question to you is if we get into the end of Q3, into Q4, and we don't really have much, let's say we have this 10% across the board. Let's say there's some, China's got 30% right now. Certain industries like autos and steel and this, they still have high tariffs on there. Are we going to start seeing a drag on the economy? Or if we have a bunch of real deals, is that an accelerant to this economy and the global economy?
I think that deals will help. I also think that it's been clearly the law of diminishing returns in terms of the job owning, right?
Yeah.
Meaning job owning.
Losing credibility is what you're saying. It's a taco trade, basically.
Basically, it's about to say that. And it doesn't behoove anybody on either side to be hardballing this. And so I would venture to guess that it'll probably be drawn out longer than people think. But, Canada and Mexico have to be careful because they got to put together that new plan too. But at the end of the day,
USMCA, you mean? Like
yeah. But I do believe that,
which is the same as the old plan.
Exactly.
Which was the
plan.
Which was the same as the old plan.
Yeah.
No, I mean, seriously.
Exactly.
NAFTA was USMCA, and this is going to be USMCA.
Let's just rename it. It'll be named something different. I don't know what it is. But I think there'll probably be some, not as what everybody thinks, but the likelihood of all of this coming together, especially given the fact of how the markets have come back, are telling the rest of the world that the American exceptionalism trade is not over.
Okay, and that's a great point, but what about the U.S. dollar on the flip side of that?
Well, so technically, again, I'm not a dollar person or currency person, but, these multinationals do better, right? That's number one. Number two, I remember the day that the dollar bottomed in 2011. I was in Zurich, Switzerland, talking to an institutional account, and the CIO of a very, 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 very big Swiss bank was telling me,
buy dollars.
No, dude. He was saying, I feel like I'm live, dude. He believed that the world's reserve currency was going to be the Swiss franc.
Yeah.
I knew that was the bottom.
Yeah. Okay. I got you.
So the more job owning we hear of that, but from a sentiment perspective, but I wouldn't be surprised if the dollar finds a bit of a bottom here, especially if rates cut.
It's funny. I said this on Fast Money last week because, we've been spending a lot of time. None of us are currency strategists. We do have some smart folks who have a beat on currencies. We've had these sorts of moves over the last 10 years, probably. And when I say 110 to 97, these are 13, 14% moves. We've had plenty of them, over the last, 10 years or so. So I look at what's going on here and I'm in your camp. I think in the meantime, it's going to help Q2 earnings. It's going to help Q3 and Q4 guidance from these big multinationals, which are all huge components. The S&P did get your $275
right,
number.
And we haven't even talked about industrials, one of the most eclectic sectors in the market that are going to do very well in a weak dollar, right? Because you have so many of those companies that feed into operations outside the U.S. We haven't talked about energy. Energy is a really interesting thing because we've seen energy prices peak up here a little bit, but net on net, energy's not been a good performing sector this year. And I think we talked about that last time. Anytime that you have the year-over-year price change in WTI negative, energy underperforms. And so you need higher prices for that. For energy.
What about with what OPEC Plus just said? They're going to be pumping a lot more oil.
So you have more supply, the prices are going to go down.
Yeah. Okay. Yeah. Healthcare really quickly. And so, you like to be contrarian. I'm just curious.
We like United Healthcare.
Okay. Which is very contrarian.
Thank you. Yeah. Well, I'm a Minnesota guy.
Yeah.
And I'm not being stubborn, but people have to kind of peel back the onion here a little bit and understand that United Healthcare has been under investigation from the Department of Justice since 2005. And their recent guy got over his skis. The new CEO took over from the guy that really built the company, Bill McGuire, took over in 2005. They got him back. They are so, from what I hear from people in Minnesota, because I talked to a really good friend of mine who's a CFO for a healthcare company in Minneapolis, and I'm like, hey man, should I sell my United Healthcare? And he's like, don't do it. I'm like, why? Because I golf with a couple of them. So we're teeing off, and all of a sudden, some guy's phone goes off in his back pocket, and he goes, what the fuck are you doing, man? We're golfing. Guy goes, we're on call 24/7, brother. This guy's an executive level at United Healthcare. I'm like, ooh, let's go, right? They're all on. That doesn't mean that you should buy the stock. It just means that for what they're hearing is they're kind of refocusing on what they're going to do. And that's what I like to see once a company's tripped. You got a CEO in there that's laser focused on turning the company around from an operational perspective and really use the cash the right way. So from a pharma perspective, we like biotechs better because of cash flow and research and development and pipelines going forward. I think it's tough to own pharma in here because from the legislation coming down the pike and maybe some devices, but I think it's okay to be neutral. You should not be overweight, Alex.
All right. Very last question. 6,700. This is how we started this conversation. Yep. That's your target right now. That would be 500 S&P points from here. You just also mentioned the potential for a blow-off top. What does it look like, a blow-off top, and does it get to your 6,700
I think
target?
We'll pass on the blow-off top. We'll blow past 6,700.
Really? You think there's like 10% from here?
It could be.
People will be fighting that the whole way up?
Oh, yeah. And then you got everybody believing it. And at the top, people at 7,000, they're going to go, you're wrong if you're not long. You'll have all the bears on CNBC talking, and then I will be scared shitless. And I'm hoping and praying that 67 holds by year end.
All right, my main man, Brian Belski, BMO Capital Markets. Thank you so much for being back here, my man.
Thank you.
Thank you.